Good afternoon. My name is Russell and welcome to this week's webinar, which is focused around investing outside of the top ASX 20 stocks. Before we start, let me cover some important webinar housekeeping. Today's webinar would not be possible without the ongoing support of our sponsors. We would like to acknowledge Think Tank, BGC, Magellan and Lowell Resources. Today's presenter is from Switzerland, Contango, who we also note have been long-term supporters of us here at the AIA. I also need to mention our general disclaimer. Today's webinar is for educational and general information only. No information provided today is personal advice. Should you wish to explore any of the topics discussed in relation to your personal position, you should seek financial advice. Today's presentation will run for approximately 30 to 35 minutes, followed by a 10-minute Q&A session. We will have enough time to put 3 to 4 questions to Shawn. Attendees will be able to table questions during the webinar using the Ask a Question feature. We'll try to get through all your questions, but we do apologise if your question was unable to be put to Shawn, given the volume of questions we normally get. I should also mention that all attendees will be emailed after today's event a link to the recording of today's webinar. Now let's get on with the webinar. I have the pleasure of introducing Shawn Burns. Shawn is the portfolio manager of the Switzer Dividend Growth Fund and the Contango Income Generator Fund. These funds are ASX listed under the codes SWTZ for the Dividend Income Fund and CIE for the Contango Income Generator Fund. Shawn has 30 years investment markets experience, and I reckon that makes him a stalwart of the investment community. During his 30 years of investment market, he has had various roles covering stock analysis and portfolio management for several large international investment managers. Shawn has managed portfolios ranging from several $1 million right up to a few $1 billion. Shawn's presentation today is entitled Investing in Mid-Caps During a Downturn. Thank you to Shawn. Over to you.
Thanks very much, Russell, and thanks everyone for your time this afternoon. What I'll go through here is I'll go through our market outlook, and then I'll go through some characteristics of the Contango Income Generator Fund, which is LIC, a listed investment company. And then at the end, we'll go through portfolio structure and also look at a stock, and then happy to take your questions at the end. Okay, so that's our disclaimer. Please read that. It's pretty much what Russell said earlier. As Russell said, I've been in the investing since 1985. I think I started managing money, so a long time across many business cycles, etc. So happy to take your questions either here or email them through afterwards if you want anything answered. Now onto our current market view. So obviously very interesting time in the market at the moment. It's always interesting. Now it is exceptionally interesting. We're always thinking about, everyone always mentions a black swan event, what exactly that is. I think we've got a pretty good example of one here at the moment. This is something that no one really knows where it's, no one can really forecast it. No one can see where it's going to come from. And also how that runs its course has a great deal of uncertainty around it. It's from, we were watching it very closely, as it started in China, and then it looked like it had been contained, and then we thought, wow, that's good, that's gone, and then obviously it got into Europe, and it's only now starting to temper its growth rates. So severe impacts on the global economy that has become from governments instructing shutdowns and lockdowns, so enforcing economic closure on the economies, and also that the markets have been impacted very quickly. We've seen one of the quickest bear markets of all time, a 20-30% fall in only a matter of a couple of weeks all around the world, and this coordinated all around the world. The interesting thing about this has been the significant global response by governments and central banks. Since governments introduced these lockdowns, they were thankfully very quick in coming to the party and trying to counteract the negative impacts of those lockdowns with government stimulus around the world, and the central banks did their parts by putting immense amounts of liquidity. I've seen studies that said the amount of government stimulus is the largest since World War II on a global coordinated basis. So they've certainly fired all cannons to try and offset the impact of this slowdown. When we go back to late March, I found it very hard personally as an investment professional to work out what the coronavirus actually, how to measure that and how to get ahead of the curve and try and think about when will it peak, is it going to peak, how far is it going to go, etc. And also combining that with the government stimulus and central banks liquidity. So after all of that, what I ended up coming to the conclusion was that I'd look at the high yield bond markets as they are the riskiest companies, and try to see whether how they're being priced, and whether they were finding any support, because it's important that risky part of the economy hung together and then drag the rest of even the strong companies down. So I saw them as a canary in the coal mine, and I was watching them. And at the end of March, it did look pretty diabolical there for a while, but then it bottomed around only towards late March. All of those high yield securities started to rally on the back of the government support and central bank support. And I thought that's when we could see sort of like a bit of a light at the end of the tunnel. The outlook, looking forward, the outlook is still uncertain, and we're seeing stability in the high yield markets, and that's run on to equity markets. So we've had a very strong rebound from those levels. There is probably two assumptions underlying or implied into that market rally going forward, and that is that the growth rate of the virus is peaking, or has peaked. So growing at a slower rate, so slowly getting under control around certainly the key economies of Western Europe and the US and Northern Asia. And then and also that government support and stimulus is ongoing and sees this through, that they suddenly decide that if there's a premature pulling of support, we could be in trouble, because certainly the economy is not strong enough to stand on its own legs at the moment. And also, if the infection rate suddenly skyrockets again, then you'll see equity markets having a bit of a rethink about what they've just done. Post all of this, what do we see going forward? I think that you'll see the post-COVID world will be growth-starved and low interest rates ongoing. When we said the GFC, as you may remember, certainly I remember, there was a lot of liquidity went in the system, and people thought there'd be inflation and this and that, and strong growth, etc. That's all cancelled each other out, and I think we'll probably see much the same here. We'll see a cautious growth outside of that, low interest rates ongoing. So no relief for those people who are relying on high interest rates or reasonable interest rates to earn returns on their capital for a living. We see that go ongoing into the future, and it's probably got. It was before COVID. We see that sort of after COVID is going on, and probably more reinforced. And so the main policy risk, as I said, that would be withdrawing liquidity support or government support like JobKeeper, etc., that we've seen, which have looked like they've been actually quite probably the best policies to put in at this time to support the economy. Withdrawing those would be a big mistake. And the chart down the bottom there, you can see, I'm sure all of you are aware of how fast. I mean, the surprising thing is just how fast that fall was. One of the quickest falls ever on the stock market, and then also the rebound we've had just recently from here. Happy to take any questions on that at the end. Now I may just talk through the fund I run, or the two funds I run, but one of them is the Contango Income Generator Fund. It is a listed investment company, so LIC. They're they're different type of investment vehicles. They're companies. They're literally companies. So they have a board. They have shares on issue, and this company in particular has investments, collects dividends from those investments, collects capital gains, and pays them out, and tries to smooth a dividend out of that. So, so we've been successful in paying a dividend over time. LICs have been, they are basically retail investment vehicles, and they do get knocked around in market volatility, and you see discounts open up to NTAs, which some people see as great opportunities. Obviously, holders aren't happy about them, but they do offer opportunities for people looking to buy cheap entry into these shares. And specifically for Contango Income Generator, CIE is its ticker. And I've been running this fund now since 2015, and the strategy since 2012. So we've got a fair bit of a track record on that. And why we set it up was to provide diversification away from large cap companies. When we saw a look through a lot of Australian retail, it's an Australian phenomenon more than anywhere else, that a lot of retail investors held the big banks, held Telstra, maybe a couple of other stocks like Woolies or BHP, etc. And that was it. So we thought, well, yeah, there's a lot of concentration risk in that. We put together a group of stocks outside of the top 20 that'll be able to pay out a yield and diversify the risk of that. So we look for companies that are moderately growing, fairly stable, have established businesses, has cash flows, pay dividends, have reasonable balance sheets. Just going forward, this pie chart here shows you the market cap. That's Australian market by market cap. So the top 20 is that big light blue area. So that's very unusual on the world basis to have the top 20 being such a large proportion of the market. If you go to some of the bigger markets like the UK or the US, etc., you'll see a much more balanced outlook, and that brings across concentration risk in portfolios. Only a few companies are held because they're just so large. The other two, the dark blue at the top there and the purple at the bottom, are the remainder of the market. So we just split them broadly into those stocks which don't pay dividends and the purple ones which pay dividends. So X20, the pay dividend, is the main focus of the fund. We don't stay exclusively in there. We do cherry pick a few out of either segments, but predominantly by 80-90% of the fund is in that purple sector of X20 stocks that pay dividends. Moving on, this is a bit of a theoretical portfolio management sort of 101 here. So as I was mentioning earlier, those companies which make up a concentrated portfolio like the banks and Telstra, Woolies, etc., that is symbolised there by that blue circle. So you're getting a certain amount of risk for your return. When we put this strategy together, what we wanted to do was saying, well, if you blended a bit of this strategy in with your existing holdings, you actually diversify your exposure, so you reduce your risk, and hopefully we can return a similar rate of return over time. So diversification, reducing risk, and hopefully delivering returns through a bunch of stocks outside the top 20. The features of Contango Income Generator, what does it offer? We pay income quarterly. Over the last year or so, it's been about $0.01, and we've been trying to fully frank that as well. We've been up to 100% franking on that $0.01. We made a few changes probably about a year ago where we reduced the dividend but increased the franking ratio. It's a relatively high yield and complements, as I've said just beforehand, complements existing income portfolios with those large cap exposures. And CIE has got a large income and value tilt. It's trying to get those companies which most of the value comes out of dividends and not growth. So we have a skewing towards dividend paying stocks. 10% discount to NTA. Keep your eye on that. That moves around a lot in this type of market. So sometimes that discount blows out to much greater level than that. And ASX code is CIE. I'll spend a bit of time going through this. So I think that what we've so you can see the portfolio's top 10 holdings at the moment, and the sectors represented on the left-hand side. You can see that I'd say that there is a skewing here towards what we would ordinarily think fairly safe companies, dividend-paying companies that have paid dividends for years and have balance sheets and cash flows that can sustain those dividends. Obviously, what's happened in the last couple of months has been raised a bit of a question mark over some of those, and a lot of uncertainty over actually what dividends companies are going to pay going forward. On the right-hand side, you can see a list of stocks there. Mainly, they are solid dividend-paying companies, and we've tried to skew those holdings to ones which we think are either going to pay good dividends, or we see significant capital upside in holding the shares. So Aristocrat Leisure at the top there, that is one of what we'd say one of our growth stocks. We think it's a very strong franchise in what they do. We think they're a leader in their field. Certainly, a lot of their competitors are now way over indebted and struggling, especially what's happening in these economic conditions. We think Aristocrat will come out of this the strong man of the industry and do very well in the foreseeable years going on from that. So that is an exposure where we're not expecting a lot in dividends, but we're expecting a lot in capital growth. As we go down the list, you can see APA Group, that number 3 there is a pipeline operator. That is probably one of the stocks which has been least affected by the lockdowns. Its cash flows are still ongoing. Its counterparties are BHP, Rio, Origin, AGL, so people who can pay their bills. Very useful in this environment. And then the next one down is AusNet, which owns electricity distribution grid. So again, gets a guaranteed returns. ASX, very solid company paying a franked dividend. Charter Hall, we see that as one of our growth companies. And then down the list, you can see another infrastructure stock in Spark Infrastructure, another electricity grid. HPI is an interesting stock. That's a small pub owner, and it's basically a landlord, and its main counterparty is Woolies, I think it is. So it's very important to have a very strong counterparty on the other side who can pay the rent in this environment, and which they have, which is one of the reasons why we hold it at such a high weight in our portfolio. On the left-hand side, you can see REITs as a large holding because of their stable income. Financials, because mainly they carry less debt, pay a lot of franked dividend, and getting franked dividends has been a real challenge over the last few years, and it's going to be even more of a challenge with what's happened in the major banks over the next year. We put a lot of time in thinking what is the lowest risk way that we can access franked dividends. And that is, and as I said, it has been a challenge, and it will continue to be a challenge. The rest is a diversification. So you can see that, it's diversified. So if we get a stock wrong, our thesis is broken on the stock, it doesn't undermine the whole portfolio. We like to have a spread across many sectors with a skew towards yield and cash flow and good balance sheets, and across many stocks. During these uncertain times, we have increased the number of stocks and increased the sectors. So we're carrying up to nearly 50 stocks now, which is the highest it's ever been. And the reason for that is if something comes out in these uncertain times, there's suddenly a government directive which targets one of your stocks, it won't have as big an impact as if you held 10 or 15% of the portfolio in one stock. Moving on, I'll just go on to one of our stocks in our portfolio. This is a relatively new stock, and we probably sat down and probably about 18 months ago started thinking about we do sit in the value bucket, we sit in the yield bucket. That's been a difficult from a total performance bucket to be in, and that's a worldwide phenomenon. Growth has been the area to be in. So we thought, well, instead of having 90-95% of the portfolio in yield and value, how about we reduce that, introduce a few, do some work on some growth stocks and get a more balanced portfolio, and maybe run that percentage up to 15 to 20, and they can supply growth, capital growth, which we can pay out through the LIC as dividends. And one of these stocks is Appen, and that's so we like this. We like the balance sheet. We had a good chat to the CEO. We've been looking at it for quite a while and looking at the financials, and that's its share chart. There, what it actually does is extremely interesting. What its biggest customers are the big IT companies like Google, etc. And what it does is, if you go into a search engine, say like Google, and you put in a word, and all these websites come up, and that's the mechanism going through to sort of say, well, what are you really trying to look at? What do you actually want by putting these words in? What would be most useful websites to you? Appen does the work on that. So what they do is they hire a big crowd, like thousands of people, and they get them to answer questionnaires to see, and the idea of that is to finesse word search to make it more accurate and more relevant. And relevant is probably the most important key for that, because things change over time. A word may have a certain association at one point in time, has a different association at another point in time. So they do that for the large companies, and that's the large big tech companies. It's a critical part of what they want to do. They obviously want Google wants its word search to be excellent, the best, and so Appen does a lot of work for those businesses. And I think that it's when we bring into the portfolio, we're looking for cash flow. We're looking for, it's got no debt, it's got cash on balance sheet, successful business, very profitable, and has growth opportunities. And you can see that this is a sustainable business going forward, and it is growing strongly. So that's why, and we've brought several of these companies in that we would say are growth companies to balance the portfolio up. So we just don't sit in the yield bucket, and that's probably been fortuitous in a way, because what has happened with a lot of those value type yield companies have actually had their dividends. We suddenly have a big question mark over their dividends, such as the banks, the insurers, some of the REITs. They will not be paying dividends, or nowhere near as big a dividend as they have in the past. So having a more of a balanced portfolio is a healthy thing, I think, going forward. Actually, I've gone through that pretty quickly there, Russell. So maybe we can take a few more questions. Covered a lot of ground, but happy to take questions from any of the people.
All right, thank you very much, Shawn. We do have a few questions that have come through from the attendees. Our first question is from Peter. How does the mid-cap universe compare to the large cap universe in terms of dividend yield?
Well, that's a very good question, and it really swings on the four major banks. So, and it has varied over time. That's the other thing to keep in mind. It has moved over time. When the banks swamped everything in the Australian market, and by the four major banks, I mean Commonwealth Bank, NAB, ANZ, Westpac. Those are such large dividend payers and such large companies that you often, sometimes we think, oh, we've got a reasonable yield, let's have a look. Oh, we're way behind because the banks are now offering a very high yield. So that swings through the cycle. Usually they will be similar, but they can vary a great deal depending on where those four major banks are yielding. So that brings us to today. So that's very interesting where we are today when we look at what will the four major banks be yielding. It's when you look at consensus data, they're thinking they'll be paying 5% dividends, but we've just seen ANZ and Westpac defer their dividends. And the speculation there won't be a dividend from ANZ at all. And National Australia Bank pay a very small dividend of 30 cents, where for the half, where they're paying $1.66 for the full year last year. So that's so there's a big question mark over exactly what the top 20 is going to pay in dividends. You have a stock like CSL, which is 10% of the market, yielding 1%. So that's the other impact.
Should I offer like a joint training for everyone on how to do data sheets for people that have no idea how?
Sorry about that. Shawn, seems to be some interference.
I thought that was another question. I'm wondering how I'd answer it.
I was trying to work out where it was coming from. Back to you.
Yeah, so that's. I think that's probably all I'd say on that. The two major influences on the top 20 are the four major banks. Big question mark over where those yields will settle for those guys, especially in this financial year upcoming to over the next 12 months. And CSL, which is the biggest company in Australia now, offering 1% yield. So I'd say the X20 is probably looking pretty good compared to those right at this moment.
Okay, excellent. This is a question from John, and John asks a question on a couple of mid-cap stocks. One is Bapcor, which is the code BAP, and Credit Corp CCP. Are these of interest, and do you have any comments on these stocks?
Yes, we're a holder of Bapcor. It's not in our top 10, but it's just outside our top 10. We've spoken to Daryl Bottomley, lots of times, and the CFO Greg Fox as well. That's what do we like about Bapcor? It's a retailer, so we are usually quite cautious on retailers because, especially discretionary retailers, because they're such fickle businesses. And you get hit something like now, you suddenly get, you can get knocked around quite a bit. We don't place Bapcor in that category. We place Bapcor in more like people have to use it, so it's non-discretionary. And we think they're pretty good operators. They raised some money a couple of weeks ago. We participated as strongly as we could in that to make sure we weren't diluted. And so we think that I'm just trying to think, I think probably Bapcor is the only retailer, if you call that a retailer, that we own in the portfolio at this time. So I know we own one more, but that's we don't own very many, but Bapcor is one we own, and because we see auto parts as more of a non-discretionary type expenditure. In terms of Credit Corp, that one is a little bit more difficult, especially now. I see they've raised money as well. I think we did participate in that raising, though we don't own a lot of Credit Corp. Well, what I'd say, and we have looked at them quite closely. I've spoken to the CEO. We think they're leaders in their field. We think they are the best operators in their field. But their field is basically collecting debts and buying debt books and then collecting debts. And that is going to be, you could easily paint scenarios where that's going to be quite difficult over the next year or so. So it's really, we think they're the best, and if anyone can do it, they can. Though collecting debts with unemployment going up and also lockdowns making it very difficult to actually get money, it's going to be a challenge for them. So we're probably buyers at the right price at Credit Corp, but we certainly haven't chased it up.
Okay, excellent. And another question, this is from Carol, and it relates to the dividend on CIE. What is your outlook for dividends in the near, medium, and long term?
Yes. I think that and the dividend, I have to preface this by saying that the dividend is a responsibility of the board. So what I think and what I say has got some impact, but the board has final say. Now, from what we can see at the moment, and remember that LICs are very unusual. They're companies, and how they pay they're not unit trusts, so they can smooth their dividends. And I think that, and we've been writing in our reports that we think we have got our final dividend for this year. It looks like it is we will be paying a dividend, and it should be a reasonable dividend, and it should be reasonably fully franked. Into the next financial year, I think that's we just have to see how that goes in terms of, like, if we get any type of stable market or any upward market, a strong market or stable market, I think we'll be okay. We'll be paying dividends. If we go through what we've just been through in late February and March, that could be a bit more problematic. We don't want to see that again. But at this moment, I think we can pay our next dividend, and we'll see how we go into the next financial year.
Perfect. Okay. A couple of more questions around stocks. Are you comfortable holding Sydney Airports?
Yeah, Sydney Airport. I think that's one that we do hold it, so we're comfortable holding it. That's how quickly that recovers. It's a prize asset. It's a first-class asset. Obviously, going through very tough times with their business down like 95% at the moment, or it doesn't have a big operating cost base. It obviously can't pay a dividend at the moment with what's happening. If we get some type of domestic airline routes back up, and some type of network system just around Australia, or even Australia and New Zealand, that would be a good outcome for Sydney. That can probably wash their face, and they start to pay some cash out. I'd say that, and then you have to wait for the international to recover. The share price where it is now was $8 only in January. So it is a case that you won't be expecting any dividend this year from it. Hopefully it starts to get back on track next year, paying dividends if the domestic route system comes up, and then we start to get even New Zealand would be even travel to New Zealand would be a good thing for Sydney, because a lot of the travel goes through New Zealand, and domestic, that's probably a viable situation until it gives time for international to grow.
Do you have a strong view on when major international travel will pick up again?
I think it'll start. I think hopefully domestic by the end of this year, and then maybe New Zealand at the end of this year, early next year, and then I think it becomes a country by country. If you listen to Webjet, you listen to Qantas and Sydney Airport, etc. They sort of saying the same type of thing, that it will become like, that this country and that country agree that they've done enough, and they will open it. So I'd say very slow progress through the calendar next year, so 2021.
All right. So thanks, Shawn. One last question around another stock one. It's the stock code ALU, Altium. Do you have a view on holding that stock?
Yeah, that's a bit more. When we had a look at some of the, so this is an X20 growth stock, strong growth stock. We're looking at that. That's a bit more. We found that a bit more complex than Appen, so it's taking a bit more time to sort of get our heads around. What they do is designer boards, and so I think that it is. It's a proper business. It's a very profitable business. I probably haven't got a strong view on the share price or its growth prospects at the moment, because it's just we are having a bit of a look at it. It is of interest. We haven't progressed too far down that. We haven't come to a final conclusion on Altium yet.
Okay. One last question from Ross in relation to your portfolio management. What defines, or what are your triggers when you remove a stock from the portfolio?
I think that the good story of removing a stock from the portfolio is if it gets so expensive that you can think, well, especially if we have a yield focus, if we're holding the stock just for its yield and maybe a little bit of growth, the stock price goes up, and then is yielding very much. and we sell it out, and so or gets taken out. So we've had a whole series of stocks like Dulux, etc., get taken out over the years. That's a happy conclusion. It's the other side is if the thesis is broken, then you think, well, why we were holding this stock? Why should we still be holding it if there's been a significant change of events, and we make sure we exit and move on? I think that the difficult, I'll probably add just the difficult thing right at this point in time is the lockdowns have brought a lot of question marks over certain stocks, and you just think, well, is this temporary or is this long term? Can the stock survive? Will they have to raise equity? Will they be raising equity? Can I participate in that? And how long does this process, this whole lockdown go on? And how much strain is the business under? Is that a thesis? And the share price has obviously reacted. Is that a thesis being broken, or is it just a temporary issue that it'll travel through? So we're spending most of our time at the moment going through each of our stocks we own with those questions.
Yeah, okay. Just one last question, Shawn. Obviously, super funds have had some liquidity, or some funds have had some liquidity issues around the new withdrawal opportunities for members. Did you notice any sort of major change regarding mid-cap stocks compared to large cap stocks as far as funds selling down to gain liquidity in their funds?
Not yet. We look at it every day. You may see, and that's going to be difficult to see because we know a couple of the super funds like Host Plus, etc., or Rest, who have a large proportion of people employed in the hotel industry or the restaurant industry, etc., service industries. They would be they'd be the ones who would be drawing down their super, or they'd be the major users of drawing down their super. Now, what stocks do they hold? What stocks do those two big funds hold? You could be, we could have there could be a few bargains come out of that from our point of view. If they have to sell down their positions, usually they can see this coming. They'll try and avoid any forced sell down as much as they can, I suspect. But we look at it every day. We look at share price moves every day. If something's falling, we usually give it a couple of days just to see whether they're about to make an announcement, and then come to a conclusion whether we should be buying it or not. And if there's forced sellers out there, that's usually a good time to buy.
Okay, excellent. All right. Thanks, Shawn. A big thank you from the Australian Investors Association. It's been an honour to have you present at this week's webinar. For attendees today, thank you for attending. Hopefully it won't be long until we all see each other again at one of our regular AIA events. Thank you.